here we got JP Morgan's, oh boy, JP Morgan's earnings release. Now, usually these are massive. I mean, just take a look at what the CEO had to say. This is all the CEO's topic right here. I'm like, all of this right over here. So yeah, it's a lot. It's a lot. Obviously, we're not going to cover all of that. So let's get on with this. The first things first, we got the ROE up 20%, ROTCE up 25%, CET1 capital ratios. We got 13.8 for standard, and I believe this is, I don't know what ADV is, man. I hate banks. Banks are always, what was that? Advanced, I guess. 13.9%. Total loss absorbing capacity, $494 billion. Standard RWA 1.7 trillion, cash and marketable securities 1.4 trillion, and average loans of $1.2 trillion. Now, here's the thing, man. This is why I'm only invested into one bank because banks are just so stupidly complicated. It's not even funny. Like, honestly, the only bank I'm invested in, guys, personally, and it's like about $500, and that's it, is JP Morgan. And I gotta be honest with you, this is one of my few companies that I'm just like, I don't know what it is. Like, I really do not know. Like, it's very, very difficult to understand. Banks in general are just stupidly difficult to understand. So that's why I only have like one exposure to it, and that's in the form of JP Morgan, the biggest bank in the United States. And aside from that, I don't want to touch any one of them else because it's just absolutely crazy. Now, let's jump into what the CEO actually had to say. So I'm going to zoom in on this a little bit. That way everybody can see. Can you see that pretty good?
Yeah.
All right. I'm only gonna read a few, maybe the first paragraph.
The juicy bit.
Yeah, well, they're all, dude. It's all going to be complicated no matter what. We got Jamie Dimon, Chairman and CEO, comment on the first financial results. Quote, we reported another quarter of strong results, generating a net income of $13.3 billion and an ROTCE of 23% after excluding net after-tax gain of $1.8 billion relating to First Republic transaction, as well as discretionary after-tax investment securities losses of $0.7 billion. Even after the First Republic transaction, we maintained an extraordinarily strong CET1 capital ratio of 13.8 and had $1.4 trillion in cash and marketable securities. While we expect material capital changes with the financialization of Basel III, and probable changes to come for banks' liquidity, we will manage to any new requirements as we have demonstrated in the past. However, we caution that material regulatory changes would likely have real world consequences for markets and users. Now, let's come over to this. Now, this is kind of already what we saw, and this kind of summarizes everything. So we got firm-wide metrics, reported revenue of $41.3 billion and managed revenue of $42.4 billion. Credit costs of $2.9 billion included a $1.5 billion net reserve build and $1.4 billion in net charge-offs. Average loans, look at average loans up 13%. Average deposits down. What?
Yeah,
what?
Yeah. Again, you called it last earnings season that these banks are not. They're all susceptible to the same exact things that FRC, SVB, and deposits are going down. So. Now, with JP Morgan, remember, they have a clientele that is more market focused.
Yep.
So there is some explanation there but again, people are let's say you have 3 bank accounts, right? You're going to consolidate it to the bank that's offering you the best fees or whatever.
Right.
JP Morgan kind of is a bank that has a lot of fees with its banking. It has very good banking, but it has, for those people that are, let's say, lower on the totem pole, for lack of a better term,
well,
they don't have the ability to pay those fees because they can't get to those requirements, let's say, of like $2,500 every single month on direct deposit, or insert requirement here.
And on top of that, remember, they did get a massive influx of people after FRC went down. So just keep that in mind. But this right here is really concerning. The 13% average loans up. Wow. Okay. Dude, that means that people are taking a lot more loans. For what though? Right? For what? Because housing has not crashed. So that means that people, remember when we saw those dips in the whatchamacallit, in the 30-year mortgage, and you can actually correlate that to the overall housing supply?
Yep.
So is that it? But that's still a stupidly high, 30-year mortgage. That's absolutely crazy. All right, let's
Well, because
yeah, okay, yeah. What's up?
again, there's margin.
Right.
Margin also
There's
falls
also a
into
ton
that.
of margin as well. Yeah. Average deposits down 2%. Client investment assets up 42%. Oh my lord.
Yeah, but that goes
Yeah,
that
what's
goes
up?
back to the deposits. Depositors are outflowing from banking, going to market.
Average loans up 19% year over year and 15% quarter over quarter. Card services net charge off rate 2.41%. Debt and credit card sales volume up 7%. Active mobile customers up 10%.
The assets under management, that's where I want to be
Right here?
looking at.
Right here?
Yeah,
Yeah, the assets, yeah, the AUM.
3.2 trillion, up 16%.
Look at that, man. Assets under management is up a whopping 16%. Is that year over year or is that quarter over quarter?
I believe it's a year-over-year metric. Whenever it's usually numbers are defaulted to, or correction, it could be quarter over quarter, but I'm going to hypothetically say it's the year-over-year number because traditionally, when they're not displayed, they're always year-over-year. That's just a traditional thing that I've seen or noticed with banks.
I guess. All right. So that's just absolutely massive. 3.2 trillion. By the way, we are going to take a look at the assets and liabilities in just 1 second. And here we got the significant items. We kind of already saw most of this, right? $2.7 billion. Oh, that's where the 8 came from, by the way. $2.7 billion from First Republic. Bargain purchase gain in corporate. 91 cents increase in the earnings per share. So that's what we saw in the Seeking Alpha article. I still think, man, I honestly still think that all of these regional banks crashing is just a way of banks doing a hostile takeover without having to go through any of this. Because look at this.
And they're kind of bragging.
Well, yeah, exactly. Thank you so much. Say that one more time.
They're bragging.
They're literally
Bargain
bragging.
purchase.
They're literally bragging.
Like, what can you describe that as? It's literally them saying, I am better than you type thing,
No,
right?
you are. That's absolutely correct. They're absolutely bragging. Look at this. A bargain purchase gain in corporate, 91 cent increase in earnings per share. If it was a liability, they wouldn't mention this. Absolutely not.
And not even that. So, like, when their assets grew to 3.2 trillion, that's 500 billion in increase. So now you have to go buy 500 billion worth of bonds. You can't hold these assets without having, because they're liabilities to you.
Right, exactly. Next we got over here, capital distributed, common dividends, guys. Take a look at this. So JP Morgan. Now we're getting more into like the whole dividend investment kind of thing. But JP Morgan does pay out a dividend of $1 per share in annual. So this is actually I don't know if they've increased this. We'll have to take a look, obviously, at Seeking Alpha, but I remember them having $1 per share for quite some time. I don't know if they've increased it. We'll have to take a look at that one. $1.8 billion stock net repurchases. So not only are they giving out $2.9 billion, which is about $1 per share, they're also buying back $1.8 billion. Wait until you see that shares outstanding graph. It's crazy. It's absolutely crazy. Net payout of 32%. I'm guessing that's like their payout ratio, which is really, really good. A 32% payout ratio is really good. And I actually really like to see this. Book value per share. When it comes to banks, they do not have free cash flow. Well, sorry, they don't have capital expenditures. Therefore, we can't figure out their free cash flow using cash from operations less your capital expenditures. But what we can use is this right here and the tangible book value per share. And right off the bat, look at this. Book value per share of $98.11 and the tangible, which is essentially the book value minus anything that is non-tangible. That's what that means. $79.90, up 15. If you guys have seen JP Morgan's share price right now, you know that is way below what the share price is right now. So we're going to get into that right now, into the discounted free cash flow. So we got to use, guys, the bank/insurance book value calculator because, again, they don't have capital expenditures. So we got the ticker for JPM, market cap of $437.67 billion. Look at that PE. So that PE alone of 11.05 with a whopping share price of $149.77. What's that telling you?
Well, it tells me it's at a good value for even its current price, which is pretty interesting from the perspective of that I think it has to drop a lot lower, but that's just my opinion.
So that, and again, guys, we can't really take a look at PE when it comes to banks. We got to take a look at book value per share. And again, this requires no assumptions to be made. So it'll be a lot easier and faster too. Nonetheless though, $149, we just saw over here their book value per share of 98, okay? Usually the tangible one's a little bit lower, but $98 being the highest, you can see that right there, that's already, that that ratio of price divided by book value, it's already massive. So I don't necessarily know how we're going to be able to buy this at this current price, but understand that it's looking expensive from a book value perspective. Now, if we come back over here, we can see how they actually traded today. And let's actually take a look at this on the 1 year. They're up a whopping 38.68%. Year to date, 10.84%. We are at 52-week highs, essentially. The highest this year was $152.89, a low of 101. So if you bought this thing on, let's see, when was that low? On October 11, 2022, then you essentially bought pretty good, pretty much one-to-one when it comes to the book value. But right now, that's looking really, really expensive. All right, let's come back into this. We can see that, obviously, we also just heard that they do pay out, or that they do give out, sorry, a dividend, and that's $4 per share per year. If we come back over here, if we take a look at the dividends, you can see a little bit more about this. Now, that is a yield of 2.7, a payout ratio of 29.52. I'm pretty sure this isn't updated. A 5-year CAGR of 12.3 with 8 consecutive years. So they've actually, yeah, this, for some reason, I figured that this right here, this hadn't moved for a while. No, they've increased this dividend for 8 consecutive years. Ex-dividend date passed on July 5th. Payout date will be on the 31st. They usually pay out the last day of the same month that they have the ex-dividend date, and they pay their dividends quarterly. So far, all of that is looking good, and based off of this $4 per share in the current shares outstanding, they pay out almost $11.7 billion in dividends every single year. All right, so let's take a look at some of these graphs. Mike, are you ready? So let's start off, guys, with the net income. We got 5 years ago of $32.47 billion to today of $42 billion. Oh, sorry, did I say 42? I meant $32.47 billion to today of $42 billion. That is an increase of 29.38%. So you can see here that 3 years ago, that's not surprising. They got a massive hit because of COVID, and then they spiked up 2 years ago, and then look at that, they pretty much fell in line with that of the 5 and 4 year ago value. Look at that. If I would have shown you just up to 2 years ago, let's pretend that this was 2 years ago, you were to see this, a lot of people would be like, next year is going to be 50 billion. And I would have been like, hang on, that's an outlier. Let's see what happens. And boom, there you go. It came crashing back. I wouldn't say it came crashing back down, but it did come down, right? It came back down to essentially the median of 5 and 4 years ago. So it was an outlier. And even as of today, they're still pretty much in line with that of the 5, 4, and 1 year ago value. So what would you give this as a grade?
So it's increasing, but staggered slightly. So
it's not staggered though. It's not staggered. It's just the outliers years of COVID, which can you blame them? And then the following year, which everything was just insane. So
let's say 95, 90.
Yeah, I would have given it a 90. I would have given it a 90 as well. All right, looking now at the total revenue. Kind of similar, right? Kind of similar. We got 5 years ago of $104 billion to today of $129.13 billion, increase of 24%. Once again, pretty consistent increase from 4 years ago. Dropped during COVID, and then a massive spike the following year after COVID, and then 1 year ago comes back down to the mean at around $122.31 billion. Again, pretty much in line with that of the 4 year ago value at $110.134 billion. And as of today, you can see that, okay, they are coming back up to the 2 year ago value, but it's still fairly much in line with that of the 5, 4, 1 year ago and today value. So, what would you give this as a grade?
Same, 90.
90? Yeah, honestly, I would say the exact same thing. Looking now at the shares outstanding. So remember when I said that the shares outstanding is just absolutely insane? This is the reason why. Look at this graph. Look at this graph, Mike. So just off the bat, look at this. We got 5 years ago of 3.27 billion shares to today of 2.9 billion shares. Look at that buyback. 10.78% on the 5 year. And from the previous to the current year, that is another buyback of 0.41. And what's amazing about this graph is, do you see it? Yes or no?
Yeah, just decreasing.
Every single year, even during COVID, they bought back. They never missed. They never missed it. So this is a perfect looking graph. This is why I look at all of this. I guess like all of the like they're them paying out a dividend, them repurchasing back shares, which I mean their earnings report even said it. They're repurchasing back $1.8 billion worth of common stock. Now, I personally think that it's overvalued. They shouldn't be buying back at $150 or whatever, but they've been pretty consistent with it. So, what would you give this as a grade?
100.
100. Yep, same. Looking now at the assets minus the liabilities. So this is the one that you were harping about, right?
Yep.
Them having a lot more assets. So here we have, guys, a very consistent. Nah, I wouldn't say. Actually, I'm gonna take that back a little bit. Not consistently increasing, but very much in that sense. We got 256 billion. We got 261, 280, 294, 292. That was the last a little bit of a drop right there. Which, can you guess? Like, do you want to guess what that might have been?
So 1 year ago, that was when I'm gonna say bonds inverted.
I would say interest rates.
Yeah, well,
I would say the interest rate increasing. And as you can see, it's only down by around $2 billion. And as of today, they're already up to $303 billion. So that's insane. Hey, you want to read me these average total assets and average total liabilities?
Average total assets was at 3.3 trillion. Liabilities 281.
No, liabilities is 3 trillion. And the difference is 281 billion. So yeah, most of these banks have their assets and liabilities in the trillions of dollars, which is just insane, absolutely insane. So what would you give this as a grade?
I'm gonna say I don't like how close it is, but it's also going up, so I'm gonna say like about 60.
60.
Or what would you? I'm not too familiar with it too. So
and to be fair, we only did this last quarter. That's when we first started doing these earnings together. My man, I would give this a 95. Give this a 95. It's consistently increasing 5, 4, 3, 2 years ago. The slight dip, which is again probably because of interest rates, and then they're really bringing it back up, probably because of again FRC and other reasons as well. But 95, it's essentially perfect.
all right.
Yeah. And lastly, actually, no, not lastly. I am so sorry. I forgot my own calculator. All right. So with all of that, I rarely do banks, guys. I only do banks when somebody recommends it or we have the earnings. That's really it. With all of these numbers, we got the final total grade. And look at this. We gave the net income a 90, revenue 90, shares outstanding, absolutely perfect, 100%. And assets minus liabilities, 95%. Overall grade of 93. There's a reason why, people are like, if you want to buy into a bank, you either get Bank of America or JP Morgan. Banks are so difficult to understand, but if you just want exposure, either the ETF or Bank of America or JP Morgan, that's it. Because look at that grade, a 93%. And you did most of these. You did 3/4 of these. So 93% is looking amazing. The problem, though, comes in the form of, well, what price we should pay. And again, looking at this, we have to take a look at the book value and tangible book value. So look at this let's take a look at the book value first. Look at this book value per share. Look at that. Look at that graph. Look at that graph, though. What do you think?
Awesome.
It's amazing. Now, as of today, this is updated. Obviously, we already saw it when it comes to this. As of today, their current book value is $98.11. And when it comes into their tangible book value, if we come down here, it's essentially the exact same graph. This is showing 75.74, but following their earnings, let's be more precise, that probably isn't updated yet, $79.90, up 14% for the book value and up 15% for the tangible book value. So, obviously, we already know the current share price, right? And, it is looking expensive. So, the price divided by the current book value is 1.59 as a ratio, and the tangible is almost double. So, when it comes to this, we want to take a look at a company that is as close as to 1.00, as close as possible to that. Under 1, it is undervalued. At 1, it is at value. And above 1 is overvalued. This is clearly very much overvalued, especially from a tangible book value perspective. It's a great company, don't get me wrong. But man, that kind of valuations is insane. Now, you said something interesting at the beginning when we first moved into this. And that was, if you believe that JP Morgan will make it out alive, will be one of the first, will be one of the few ones that will make it out alive, you're kind of incentivized even to pay this kind of valuation.
I'm going to phrase it like this. Would I do it? No, because I think you have to account if that scenario comes to fruition, everyone's going to panic sell, even JP Morgan shareholders, because it's just remember, it's the leverage of what they're leveraging against. It is basically the panic selling, the mentality. Remember, the hardest part about investing, trading, or anything in the market is the 6 inches between your left and right ear. So the psychology is going to affect it. Now, are you going to be affected by it is the other question. If JP Morgan's dropping like a cliff, I'm going to be buying every share I can get my hands on, because if JP Morgan goes under, well, I got bigger problems.
Oh, yeah. No, absolutely. You're 100% right on that.
The economy doesn't exist anymore.
Yeah. At that point, dude, if JP Morgan goes to zero, like, forget about it. Seriously, forget about it. Like, at that point, you need to buy food, water, and guns. That's literally all you need to do. Because at that point, like, society has collapsed. And gold. Don't forget about gold. But at that point, society has just completely collapsed. So, I kind of agree with that. Was that?
Don't forget silver.
And silver. Sorry. But I kind of do agree with that. Obviously, not financial advice, everybody. But you kind of are incentivized to buy into JP Morgan or any of these banks when the Treasury Secretary says, we'll bail out the big banks because they have an impact on the economy. We won't do it for the regional banks and the small banks because they don't. So it's like, hey, talk about a bailout without giving a bailout. Right? Seriously.
We'll bail them out by giving them reasons to buy these regional banks by bailing them out.
Right. Essentially, it's like they're not too big to fail, but they are too big to fail. That's pretty much what they're saying. So that's JP Morgan, guys. All right, Mike, do you want to take a look at the technicals when it comes to this?
Oh, yeah. This is one of my favorite parts.
All right. So let me pop you out and go at it.
All right. So looking at it, guys, I'm going to make this as simply as sweet as possible. They ran it up into earnings. You guys know my opinion of that. I covered in today's video that I don't like companies that run into earnings just because, well, on the daily, if we jump over to it, you can clearly see hit reversal zone. I said if you have to be above 150 on close, that we're pretty much going to be looking up into the 160s and above. You came to 152, I believe, 88, and about face reverse, and basically that's all she sung. You got lower and lower, closed the gap on the day. You did backfill it. So if we go to the 15-minute real quick, you can clearly see, massive push or gap on open, sold it off completely, filled it, defended a little bit through the day, but really didn't make much progress. So JP Morgan basically went in a circle in day, being down 0.6%, sorry. And the volume pretty substantial. So now this is a strong high. It's going to be a lot of work to get through it. You basically had this big run, so buy the rumor, sell the news, and I would be expecting to possibly see a reversal here. Now, the MACD separated with RSI, so you got some more going to do, but overall, I think that you would have the potential to keep going. You just have to see how it all plays out, because again, it's going to be depending what the regional banks do, right? So we're going to get into Wells Fargo and Citi in a second, but those, let's say, had a pretty interesting day to say the least. For those that are interested in JP Morgan, this is how simple I'm going to make this trade. Basically, you break the green line, you're heading lower, retracing 50% of this move at least, if not more, which would bring you basically back down to roughly $144.90. That's where I start considering JP Morgan. Best supports this area anywhere between the 138 to 133. And really, if you want to get hey, bargain hunting, right? We jump over the weekly. This targeting zone, 114 to 100. Anywhere in there, you start accumulating. That's pretty much would signify a double bottom on JP Morgan, which would play nicely just because this is COVID. You bottom on the tops of COVID, double bottom there, be a strong move for JP Morgan. And it would pretty much get down to like that $75 price point we were talking about. I don't think you can actually get down to 75. Stranger things have happened, but anything sub 114 is where I'd be accumulating significantly. Anything basically in the short term coming back down into this 137 to about 133 is where I'd be looking to accumulate as well, you know, building a position. And if you subscribe to the theory, like we said, that it's going to be the last man standing possibly, or one of the few. And as you see, FRC, one regional bank. Imagine if it had consumed 10 regional banks. It could easily write off almost all its losses that it could incur during any downturn, and you get the discount window now from the Fed, which these bigger players are taking extreme advantage of, and therefore it's going to be interesting to see what happens. Do we see downgrades on the regional banks, which could create more carnage? Right now, again, the GOAT has spoken and basically said he is not buying any banks whatsoever because he believes another shoe is to drop. I'm going to wait for that shoe, and I'm going to go buy the banks.
That's a very fair statement, man. Absolutely. All right, so thank you for that technical analysis. And yeah, guys, JP Morgan, hopefully everybody had, I don't know, it really just didn't go anywhere. I was going to say, like, hopefully everybody had a good day, you know, with it today, but man, it really didn't go anywhere. So
market took the most amount of money from the most amount of people in the fastest way possible.
On both sides. In fact, I believe
literally you screwed everybody but the sellers.
I believe somebody commented on your technical analysis video saying that like yesterday was a bull trap, or like today was a bull trap for yesterday's market.
I'm gonna save my commentary for the weekend deep dive on that.
Fair enough.
Because I want to see how everything shakes out, and I don't want to spoil anything.
Fair enough. All right, guys. So, with that said, that pretty much does it for JP Morgan. Man, this one was very much bad. This one was really bad. And as you can see right here, we got Citigroup non-GAAP EPS of $1.37, misses by 1 penny. And revenue, look at that, $19.4 billion, beats by $120 million. So just looking at this, where do you think everything went, Mike?
Well, full disclosure, I saw the graph.
Fair enough.
And I ate my own words because in the video, full transparency, I was saying Citi was probably the most potential for the upside because it hadn't ran, right? So I'm here sitting, okay, hasn't ran, has potential. If it comes in okay on earnings, it should have a nice move because maybe people were discounting it. Boy, did I get a slap in the face with that one.
Yes, you did. Because here is how Citi did today. 4.05% down? What?
Yep.
What? I'm looking at this. I'm like, for a penny? For a penny. Now, I'm actually curious because did they say anything here as to what made them fall?
They must have. Because you don't get that reaction on that miss, right? So you get a 2-3% down. You don't get or I should say this. You get the knee jerk, but you don't close at the lows of the day. Right. That's a strong move.
So I'm actually curious because here I do have this article, but unfortunately I need to come back over here and put it into this. But
in the meantime, with Citi, it's like
actually it was already archived. It was already somebody already archived it.
God damn, he cuts me off on the best part.
Okay, fine. Go on. Yeah,
no, I'm just kidding.
Go on.
So let's see. Citi Q2 earnings miss as market investment banking revenue disappoints. Okay, but here's the thing. Disappoints.
What does that mean?
You didn't run. You didn't really run. So, okay, it disappoints, but how did it disappoint?
Right. So we got over here. Citigroup on Friday reported Q2 earnings that just missed the Wall Street consensus as disappointing results in the investment banking and market revenue more than offset strong results in treasury and trade solutions and security services. Quote, our service business continued to deliver strong revenues with treasury and trade solutions and securities both up healthy 15%. said CEO Jane Fraser. Market revenues were down from a strong second quarter. Oh, the market revenues were down. That's why.
But I thought new bull market coming.
That's why. That's the reason why. Yeah, market revenues were down from a strong second quarter last year. They're comparing this to last year, as clients stood on the sidelines starting in April while the U.S. debt limit played out. In banking, the long-awaited rebound in investment banking has yet to materialize, making for a disappointing quarter.
Ooh,
that's huge.
Saying
That's
disappointing
massive.
in any earnings statement is a recipe.
In banking, the long-awaited rebound in investment banking has yet to materialize.
So too long didn't read version. We're screaming in the silenced room at the top of our lungs because Powell said we're going to keep raising rates for another year, and we're shitting bricks.
Okay, well, thanks for the S drop. I really appreciate that. All right, fine. No, but I agree with that statement, though. I agree with that statement. The fact of the matter is that they're basically saying, like, the rebound has yet to happen. The rebound has yet to happen. Yet, what have we been seeing in the S&P 500? To the moon, right? Completely to the moon. So, this is actually crazy.
Abysmal.
Yeah, you get like JP Morgan, very, very rosy. City's weird because City could be a regional bank, but it's not. Right? When you think of like the big banks, you think of Wells Fargo, Bank of America, and JP Morgan.
They're the biggest.
Are they really?
Yeah, I have it listed in my watch list as rankings: JP Morgan, Bank of America, Citi, Wells Fargo, Goldman, and Morgan Stanley.
I don't know. For some reason, I always thought City as I don't know. Maybe it's just me.
Citi. So you don't. It's not mainstream, right? So it's not.
I think that's why. I think that's why.
Bank and JP Morgan, like always, like more commercials than you care for, right?
Yeah.
But this is where it gets interesting with stuff.
Oh yeah, absolutely. So let's jump now into their earnings. Now, right off the bat, Citi, it is by far Citi's earnings report. By far my favorite when it comes to reading it because they put everything right there. Boom. Like right front and center. Like JP Morgan did too, but like you have to scroll down a little bit. Look at this. Returned $2 billion in the form of dividends and repurchases. Boom, right there. Exactly what I want to see. Right? Payout ratio of 76. Pretty high, but then again, it is what it is. Book value per share of $97.87 and tangible book value per share of $85.34. Y'all just saw the price, and this is the reason why the first time I ever saw Citi, I almost lost it. I almost absolutely lost it because again, if we remember, how do we value banks, Mike? Book value.
Assets.
Well, no, right. So the book value divided, or the current price divided by the book value.
Yep.
You get that ratio, right? Now,
yes.
What was the price for Citi? $45.
Yeah.
What is that book value? Almost 100. Meaning that this company is very much undervalued. Okay. And it has been for a while. So, yeah. Looking up over here, when it comes to the key metrics, we got quarter two revenues of $19.4 billion, quarter two net income of $2.9 billion, second quarter EPS of $1.33, and second quarter ROE 5.6, second quarter ROTCE of 6.4, and CET1 capital ratio of 13.3. Okay, now let's read what she had to say. And it's funny because I wish I could put this over more, but unfortunately I can't. There we go. So let's see what she had to say. Jane Fraser, amid the challenging macroeconomic backdrop. See, this is why I love Citi. JP Morgan was just like, no, everything is great. We're doing great. See, it's just like challenging macroeconomic backdrop. Boom, dropping it right there. We continue to see the benefits of our diversified business model and strong balance sheets. Our services businesses continue to deliver strong revenues, with Treasury and Trade Solutions and Service Securities both up a healthy 15%. Markets revenue were down from a strong second quarter last year as clients stood on the sidelines starting in April. We kind of already read this because of the debt limit, like how that played out. And we already saw this. In banking, the long-awaited rebound and the investment. Okay. Our card businesses had double-digit growth due to strong engagement and continued normalization in payment rates. And while wealth revenues were down, we are attracting new clients and seeing growth in segments such as wealth at work. We're remaining laser focused on executing our strategy while continuing to simplify and modernize our bank. We are on track with the plan we laid out at Investor Day. Remain committed to reaching our medium-term return targets. We ended the second quarter with CET1 ratio of 13.3, which was 100 basis points above our new regulatory requirement that goes into effect in the fourth quarter. We returned a total of $2 billion in capital to our shareholders through common dividends and share buybacks, and we will continue to review our level of capital returns on a quarter-to-quarter basis, said Ms. Fraser concluded. So, all right. What do you think of that so far?
I think she's being transparent. I think she's being transparent about what's really going on. Now, again, it's JP Morgan also had the FRC thing that they could basically be like, but again, Citi, macroeconomics, banks really shouldn't be talking about that unless they see the proverbial cliff coming up on the horizon. And they basically said disappointing because of the non-return on the bonds, right? So they're expecting bigger banks can weather it. They can't stop an infinite weathering, right? So they can weather a year or so, not 2 or 3 or 4 or 5, because every time Powell comes out, it's like tack on another year.
Right, absolutely. And I completely forgot to take a look at the financial results for JP Morgan, but we'll do it here for Citi. And look at this, man. Total revenues, quarter 2 of 2022, 19.6 billion. Quarter 2 of 2023, 19.4 billion. That is a decrease year over year of 1%. It's not a lot, but it's a decrease.
That's just flat.
It's essentially flat, but it's still a decrease though. And I think that might have been the reason. Remember, they did say that, it was the whole, was it market, market.
Disappointing quarter in the wealth sector or something like that.
Yeah, like in the, what'd she say again? I forgot what she said. Let's see.
Investment banking.
Investment banking, right.
Which consists of commercial real estate.
And that's a 1%, and quarter over quarter, 9% down. Looking at the net income, look at that net income drop from 4.55 billion down to 2.9, essentially 3. Look at that decrease in their net income. That's a 36% decrease in the net income. Absolute insanity. So, yeah, this is interesting. And even actually, their book value per share did go up by 5%. Tangible book value went up by 6%. You can see here 92.95 up to 97.87, and then 80.25 to 85.34. So Citigroup is definitely struggling when it comes. Well, I wouldn't say struggling, but they are. Man, I really want to love this company. I really do. I was this close to buying it, like very, very close to buying it. Except one thing stopped me, and we're gonna actually cover that right now when it comes to this. So we got the ticker for Citi, we got the ticker for C, market cap of 89.1 billion, a PE of 6.38 with a current share price of $45.75. If we take a look at this on the 1 year, guys, we can see that on the 1 year they're not as high as other banks, right? 3.65% on the 1 year. Year to date, look at that. That's a rarity right there. That's a rarity. Most banks on the year to date, they are up a lot. This is flat. And look at this 52-week range, $40 to $54.56. So yeah, this company just hasn't moved anywhere since January. So yeah, they're up in the 1 year, but even that isn't massive. Isn't a massive
increase. Don't go
increase.
to their max.
Why? Oh!
Yeah, Citi took a nice haircut during 08.
I did.
And I didn't know that till I saw about 5 minutes ago.
My dude, this is the first time I'm seeing this.
Yeah.
No. I have covered Citi. I've covered Citi before. I think like 3 times on the channel. I never once hit that max graph. Why did? What is that?
That was amusing,
bro.
Yeah, but here's the thing. It just shows that stocks don't always go up.
Look at what it was. Look at what it was back in 2007. $545. And it's flat. it's flat for the past almost 20 years, because we're already halfway done through 2023. You know, almost 20 years. They have not recovered in the slightest. Oh my lord, Mike, I have never seen this. Straight up, I never hit that max button before on City, ever. This is a new for me. This is a brand new reaction for me. I'm not even joking.
This is why I always go to larger time frames and start zooming out, because I'm like, hey, let's see where this goes back. And I was like, oh, that bank has a 99% haircut.
Dude, I didn't know that. I didn't know. I honestly did not know that.
But if you look at the volume on City, so
right here?
Again, well, look, yeah, you see on the lower end, like volume completely drops off, basically going into 08. Again, It could have been. Remember, price can be manipulated very easily through low volume. This is what I always talk about on the channel. So if City had such abysmal volume back then it was very easy to run to these like astronomical numbers, right? So their volume back then was absolutely like nothing. Like, for example, I'm going back to like when they were back at 500s. They were 6 million per week in volume, whereas now you're averaging 111 million for this week in transaction volume. So again, it's
cover that when we get
bikes.
cover that when you do your technicals on this, because again, you could get into a lot more than me on here, but that is absolutely crazy. I would love, by the way, I can hear myself echoing. I would love to see. I can't do this because I don't have that kind of view. I would have loved to see the book value when this thing was at peak 2007.
It was probably upside down, or I'll take that back. It probably is where it is now because, again, low volume.
Well, no, I meant no, book value. Book value.
Yeah, I know.
As in, like, assets minus liabilities divided by shares outstanding.
It'd be interesting to see.
It would be, anyway. Because could you imagine if the book value was like $5 and this thing was up to 550?
That'd be funny.
That'd be stupidly expensive. I just don't know what it was. But man, that's wow. Okay, I've stayed on this graph. Wow. Thank you so much for bringing that up. I've never seen that. That puts everything into a new light when it comes to City. Okay, they do pay out the dividend, guys, of $2.04, and again, we did see that. Well, they're very, very proud of this dividend as well as the share repurchases. And if we take a look at, we come over here to the dividends, we can see that this is an insane yield of 4.24%. Annual, well, we already know the annual payout. A payout ratio of 28.02, which is really, really good. By the way, shout out to the 11 people watching on YouTube. My God, so thank you so much. Thank you so much. And on Rumble as well. We only got 4 people, but thank you so much for the 4 of you watching. Shout out. All right. Payout ratio of 28.02, a 5-year CAGR of 9.77 with 0 consecutive years of dividend payment. This is a red flag, except that if we take a look at the dividend history, it's not that they've cut it. It's just that they're very, very stagnant with it at 51 cents. So you're not getting growth with it, but you're getting consistency with it. So I look at that dividend and I'm just like, it's not growing, but I mean, at least they're not cutting it, right? At least they're not cutting it. Ex-dividend
like City's MO is just sideways.
Yeah,
City's MO and dividend is sideways. City is MO and price is sideways. It's like,
yeah, it really is.
It's great if you're an option seller.
It really, really is. Actually, you just gave me an idea for that. I have not even looked at City when it comes to selling options. When it comes to this one, I might. Ex-dividend date passed as of April 28th. Payout date was on May 26th, and they pay their dividends quarterly. Based off of the current shares outstanding and this $2.04 in annual dividends per share, they pay out almost $4 billion. All right, so let's take a look at now their fundamentals. And here's the thing. The first one is the net income, and this is the one that kept me from buying into this company originally. I saw this, and I was just like, this is insane. The net income kills me every single time. We got 5 years ago of $18 billion to today of $15 billion. That is a decrease of 16.07%. Obviously, COVID hit 3 years ago. We saw that with JP Morgan. The massive spike 2 years ago, we saw that with JP Morgan. Except that as of 1 year ago, it did not recover. It did not recover to that of the 4-year goal. It didn't come back to the mean, essentially. It didn't come back to the median and mean as of 5 and 4 years ago. It remained at $14.85 billion. It came down from a whopping 22 years ago to essentially 14.9 billion. And as of today, they're increasing it, but we're still ways away from the 5 and 4 year goal value. So what would you give this as a grade?
About 50, because they can improve, but it's not great.
Yeah. This is
Remember, banks are going to be a little more lenient with them.
Yeah, but man, that net income, it kills me every single time. Look now into the revenue. The revenue actually looks a whole lot better. We got 5 years ago of 65.5 to today of $71.4 billion. It's an increase. It's an increase of 9%. Not double digits, but still an increase unlike the other one. Now, we do see, once again, the drop 3 years ago, the spike 2 years ago, and then coming back to, I mean, I would even argue that the 2 year ago value wasn't that much of a spike from 4 years ago either, but it did come down to roughly what it was, a little bit higher, right? Essentially like the median between 5.4 and 2 year ago at $70.56 billion. It's higher than the 5 and 4 year ago value. As of today, it's even higher than the 1 year ago value by a little bit, by around like $1 billion. So what would you give this as a grade?
About 75, just because.
I would not. I would absolutely not.
Go back. 90.
I would not. I'll put the 90. I'll put the 90. But the reason why I would actually go with 100, and here's the reason why. I'm taking these as outliers.
COVID.
Right? Yeah, I'm taking these as outliers. So if they're outliers, I'm not gonna blame them for an outlier, right?
Yeah,
I'm not gonna blame them for an outlier, but let's put the difference 95. If I was writing that down, I didn't mean to open that up. 95. All right. And looking now at the shares outstanding. Now, this one was almost perfect up until today. But on the 5 year, this is a pretty good decrease. Going from 2.37 billion down to today of 1.95 billion. As a decrease in the 5 year of 17.8%, almost 18%. However, previous year to the current year, it is unfortunately an increase of a little bit more than 0.5%. So, thoughts?
See, I don't view that as bad, just because they're taking advantage of the situation they're in, especially with the bond portfolios. I rather a bank leverage the shares than completely go belly up on the bank portfolio.
No, I agree with that.
Bonds.
I agree with that.
But now, what I would not want to see is another quarter, a second or third quarter of it. I want to see basically, okay, you increased it.
Yeah, but this isn't quarter over quarter though.
In the report, right?
Oh, okay.
So I'm not saying here. So if the year lands up as a significant increase from the next, I want to then see, because like you increase it for 3 or 4 quarters, then I want to start seeing an immediate reversal once the times, basically. I don't want to see like, oh, we increased our shares, but we're not going to buy them back now, like significantly. I basically want to see that spike and then return to the mean of the trend.
And to be fair, if we come back over here, $2 billion in the form of dividends and repurchases. So they are buying back. They are buying back. It's just that so far this year, it's a slightly higher. I think they issued last quarter, I believe. I don't remember fully. It's probably in here somewhere. If we take a look at the tangible, shares and that kind of stuff. But nonetheless, it's still it's not too bad, right? It's not too bad. This kind of increase, 0.5%, guys, is not that bad, right? So, what would you give this as a grade?
I'm gonna say like 85.
Really?
Yeah, I don't like, 80. I'm gonna stick with 85.
Why?
Because the increase
is only on 1 year, from 1 year ago to today. That's it.
Would you do what, like 95 then?
I would personally do like a 95. I would
split the difference 90.
Split the difference 90. All right. Because I mean, dude, look at this. They've been buying back for like the longest time. The one increase, and again, also, I would actually prefer if they buy back when the share price is really low, because the same principles apply, right? You want a company to be buying back shares when the share price falls, not when it increases. Like, I would not be surprised to see Nvidia issuing 1,000% in shares right now. Right? Because it skyrockets. I would not be surprised.
You know what they did right after earnings, right?
Well, you know what? Okay, let's stick with the banks. I'm sorry for bringing up Nvidia. We'll cover that.
Okay.
That video's gonna be absolutely.
Too
That
long,
live
too long didn't read version. They issue a crap ton of shares.
Okay,
2 billion.
We'll cover.
But okay, and that's all I'm gonna say.
We'll cover that when Nvidia has earnings. That's gonna be absolutely crazy. But for now, sticking with this, let's split the difference. You said 90.
Yep.
All right, 90. Looking now into the assets minus the liabilities. Now, this is not consistently increasing, and I forgot to take this out. I am so sorry. This is not consistently increasing. You can see here that from 5 to 4, they dipped a little bit, and then from 2 to 1, they dipped a little bit again, but the general trajectory is to increase, so it is what it is. Now, average total assets, it is 2.2 trillion. Average liabilities, it is 2 trillion. Doing this difference, we get $200.8 billion. So what would you give this as a grade?
I was gonna say 95.
Man, we don't do this for a quarter, and you get real rusty, don't you?
Yep.
You get real rusty, don't you? All right.
Hey, you call my stuff voodoo magic. I call your stuff I don't know.
Fair enough. All right. We'll call it spades a spades then. What you said? 95?
Yeah.
I'm gonna put 95. Oh, sorry. I'm gonna put 95. This weekend, I'm gonna add mine to this. I'm gonna add mine to it because I promised I would. I hadn't. I didn't do it, but I am going to add it just so that we could both get our both of our numbers in there. All right, guys, and with that, we get the total grade. Net income 50. Net income is bad. This is the main issue with the net income, man. It's just bad. Revenue of 95%. Just setting of 90. Assets minus liabilities of 95. Overall grade of 80. This is why I absolutely love this company. It's aside from the net income, everything is looking really, really good. Right, really, really good. And on top of that, let's take a look at now what price we should pay for this company. We kind of already figured this out, obviously, seeing that we already saw the earnings report.
Book value.
Right. So we already saw the earnings report, and, well, this isn't updated, but $96.60 for the book value, and the tangible book value, it is $84.34. Once again, if we come over here to the earnings report, we can see that the book value is $97.87. And the tangible book value is $85.34. If we compare that now, if we take that payout ratio, not payout ratio, if we take that price divided by the book value, that's the ratio. That's the ratio right there. 0.47. Remember, 1 is at value. Under 1 is under value. We just saw JP Morgan. It was almost 2 on the tangible. This on the tangible is 0.54. This is why I absolutely love Citi. I almost pulled the trigger on it. Only reason why I didn't was because of that net income. We'll see where it ends this year. But man, this thing is just an amazing value right now. It really is. It really is. So, what do you think? Thoughts?
I think, well, considering it's been sideways for so long, I really like that it's been kind of sideways, but it's also bad. And I'll get into it shortly.
Okay. So I'm guessing you're looking at it already from the technical perspective. All right. So I also forgot to do this when it came to JP Morgan, but it's about $1. $4 in annual dividends per share. But if we were to put in $5,725 into Citi, look at the annual dividends though. Look at the annual dividends. That's insane. That's insane. It's a 4% yield, so obviously, but $255 increase. And again, they're very consistent when it comes to the dividend. Not increasing it, but consistency is something I like to see. All right, so with that said, you want to do your technical analysis voodoo magic now?
Yes.
All right.
So now, like promised, we were going to go to the weekly. And we're going to zoom out to when Citi was on its crazy run, right? So again, as you can see, they had extremely low volume. Low volume means you can manipulate the price comparative to higher volume. And again, remember, volume is a perspective per se, but it's not really. What I don't like about Citi is since basically 2021, it's had a nice big downwards turn. If we go to a weekly, it kind of looks like a bear flag pattern. That's why I don't like Citi necessarily. You got the flag, which would probably bring it back down towards COVID lows, coming down here to basically $27.47. That's where I'd be looking for Citi if it has a massive downturn. Now, if you want to accumulate these lower levels that were pretty much daunting to bang our head into, I'd definitely be looking at 42.64 is definitely an area. Oh, excuse me. Would basically be an interest to me. And really, if we get down into the 40s, again, an area I'd be interested in city. But remember, I said $27 to $40 is a bit of a stretch on the way down. Again, Warren Buffett talking about that you're going to get another leg to drop. I would see anywhere below 40 for Citi would be an awesome buy, even though let's say you get a little bit of haircut on the way down. Long term, I do think it has potential, especially being the third largest bank in the United States. It's not necessarily going anywhere, especially with Goldman Sachs and Morgan Stanley, Wells Fargo being lower sizes than it. And it just has it does its business pretty well. Right now, I do believe it's going to break this trend line that when we come back down here, we could bounce. But if we break this trend line, I'd be looking somewhere down in this $40, $30 region to pick up Citi. So we have to see where it plays out. And I said, I'm going to eat these words that we basically had more upside on Citi. But again, today basically proved that completely wrong with its massive strong close of the candle, and we have to see what happens on Monday. But then again, right now we did fill this gap, so I'm happy I got a gap fill. But again, we got another gap down here that we need to fill, and we could be heading towards at least the 44 price region before we really catch a bounce. And I'm saying probably lower down to 42s, 41. But overall, I think it's going to be an interesting buy soon. Right now, no. Again, following Warren Buffett's advice, hold off. But I would definitely keep an eye on it to see if it gets into any of those regions and maybe take a snip at it.
All right. Sounds good. And yeah, guys, that pretty much does it for Citi. And you guys can pretty much see what we're going to cover next. And I guess my final thoughts on Citi is this. Guys, it's a company that me personally, honestly, if you see me pull the trigger on this, yeah. If you see me pull the trigger on this, it may be like next year or something like that. Don't be surprised, because I actually really do like this company a decent amount. I just wish that their net income got better. But anyways, that pretty much does it for Citi Group. Let's jump into, guys, the final bank, and that is our favorite, right, Mike?
Your favorite.
This is not my favorite. Absolutely, it is not my favorite. Wells Fargo. All right, guys. Wells Fargo was the last one that had earnings. Let me just... by the way, I forgot to mention, if anybody wants to follow these earnings reports, the links for all of them is in the description below. So, again, if you guys want to follow along, please see them in the description below. Again, if you guys would like to follow along, all of this is in the description below. So, let's jump into now, guys, Wells Fargo's earnings report. Now, Wells Fargo, oh boy. Unlike the other two, Wells Fargo is like by far the worst one of all of them. Major controversies pretty much across the board. And, well, if we take a look at their summary, we can see that they actually did better than Citigroup. Wells Fargo GAAP EPS of $1.25 beats by 9 cents, revenue of $20.53 billion, beats by $410 million. All right, so right off the bat, you're looking at this and you're like, okay, wow, they actually did better than Citigroup. That's surprising. Taking a look now at their actual earnings report numbers for the second quarter. Well, first off, they got everything right up here, which I love to see. And I love how they have all of their things over here, like all of like their financial statement right there, and even last year's as well. Absolutely love it. We got on the quarter ended, when it comes to the total revenue, look at this, $20.5 billion. Look at what it was last year around the same time, 17. That's a pretty good increase. You know, I may not like Wells Fargo, but that is a pretty decent increase, if I do say so myself. Thoughts?
We gotta see how it all plays out. Yeah. It's increasing, but is it increasing enough for what the market expectations are?
That's true. Now, hang on, sorry everybody. Let me just get rid of all those tabs. Okay, when it comes to the net income, look at that increase on the net income as well. $3.14 billion up to almost $5 billion. And when it comes to diluted earnings per share, diluted earnings per common share, 75 cents to $1.25. I don't, I'm looking at this, I'm like, well, the numbers are telling me that so far they're doing fairly decently. Average loans went from 926 to 945, essentially $946 million. average deposits went down. We've noticed that, right? We've noticed that average deposit
are trending down.
Yeah, the average deposits are actually trending down. And CET1 10.4% to up to 10.7, an increase of 0.3. And the ROE went from 7.2 up to 11.4, and the ROTCE 8.7 to 13.7. And here we got
Wells Fargo stopped being a turd, basically.
Well, hang on, man.
First
One
day,
quarter
so
doesn't
far.
mean anything, right?
Yeah.
One quarter does not mean anything. Looking at the operating segments and other highlights, we can see here consumer banking and lending went, what is this? Quarter over quarter went down 1%. Year over year went up 2%. As of the quarter ended June 30th, 2023, $336.4 million. Commercial banking, $226 million, up 1% quarter over quarter, and up 12% year over year. Corporate and investment banking, $291.5, down 1% quarter over quarter, and down 2% year over year. Wealth and investment management, $83 million, down 1% quarter over quarter, and down 3% year over year. Wow. Look at this average deposits though. Commercial banking was the worst one. Wealth and investment management was the worst one year over year. 35% down. Absolute insanity. Absolute insanity. I mean, commercial banking also went down a significant amount too. And then followed by consumer and banking and lending, 8%. And then corporate and investment banking down 3% year over year. So we have seen that, right? We have seen that overall average deposits are just down in general. It is what it is. Looking now at this over here, repurchased 100.2 million shares or $4 billion. Wait, what? Or $4 billion of common stock in the second quarter of 2023. They did not mention any dividends though, so that's actually fairly surprising indeed. And let's only read like the first paragraph of what the CEO had to say, because this is very lengthy. Very lengthy. All right. So we go over here. Chief Executive Officer Charlie Scharf commented, quote, "We reported solid results in the second quarter with net income of $4.9 billion and revenue of $20.5 billion. Our strong net interest income continued to benefit from higher interest rates." There it is, right? There it is. "And we remain focused on controlling expenses." Okay. "As expected, net loan charge-offs increased from the first quarter. Consumer charge-offs continued to deteriorate modestly." Wow. Consumer charge-offs continued to deteriorate modestly. Commercial charge-offs increased, driven by a small number of borrowers in the commercial banking with little signs of systemic weakness across the portfolio, and higher losses in commercial real estate, primarily in the office portfolio. Hey, you want to read that? You want to read that for me, just to make sure that I read that correctly?
Yep. Office portfolio.
No,
commercial
right
real
over here.
estate.
Yep.
A little signs of systemic weakness across the portfolio and higher losses in commercial real estate, primarily in the office space.
CMBSs. Anybody who's seen The Big Short, you know MBSs, right? Mortgage-backed securities. CMBSs, commercial mortgage-backed securities. That's what he's talking about right there. That's absolutely crazy. Higher losses in commercial real estate. That's crazy. I don't know when this CMBS bubble is going to pop. I have no idea. But man, if it has the exact same effects as the MBSs back in 2007, 2008, oh boy. Oh boy. Oh boy. We had a $949 million increase in allowance for credit losses, primarily for, there it is again, primarily for commercial real estate office loans, as well as for higher credit card loan balances. Oh Lord. Well, we haven't seen significant losses in our office portfolio to date. We are reserving for the weakness that we expect to play out in the market over time. Talk about saying the quiet part out loud. What?
And let's not forget, we can in the last statement in the second paragraph, while we expect to repurchase more common stock this year, we believe continuing to maintain a significant excess capital is prudent until there is more specificity of the new banking capital requirements, aka the Fed is going to bend us over backwards, and we're waiting to make sure that we got enough money to pay it off the mafia.
Dude, the mafia correct, right? Mafia correct. This CMBS is going to be absolute bonkers, man. And again, they haven't said anything about yet the student loans, man. It's going to come crashing. I'm telling you. We're going, beginning Q1 of 2020, well, technically Q2 of 2024, we're going to see the effects of the student loans being affected in Q3, the end of Q3 of 2023. So that's going to be absolutely insanity. All right. So with that, let's now jump into the calculator and let's take a look at Wells Fargo. We got the ticker for WFC, market cap of 163.45 billion, a P of 12.44 with a current share price of $45.75. Now, I did not get a chance to change that dividend, but I'll do it in just 1 second, guys. Just give me 1 second. So let's come over here to Seeking Alpha, and we got the company Wells Fargo. Look at how this did in the intraday. 34 down, 0.34% down, and post market down 0.07. Year to date, sorry, on the 1 year, they're down 12.44. Year to date, 4.24. Right? They're smack in the middle, 35.25 to 48.84. It really isn't anything special. It really isn't. Yeah, it really isn't. So coming back over here, they do pay out the dividend. It is not $2.04. I am so sorry for that one. It is $1.20, a yield of 2.75, a payout ratio of almost 24, a 5-year CAGR of -5. All right. If we take a look at this dividend history, they probably cut it during COVID, if I'm not mistaken. And there it is.
And it hasn't recovered.
It has not recovered, but they're at least increasing it from that point onward. I just love how I can say they probably cut it during COVID, and there it is. And there it is. So, all right, it's a COVID issue as to why they cut their dividend. Whether you blame them or not, that's really up to you. Then again, JP Morgan had the exact same problems, right, with COVID. They didn't cut it, right? Citi, they didn't increase it, but they didn't cut it.
But let me stop you there. JP Morgan and Bank of America are two juggernauts.
We didn't cover Bank of America. We covered Citi.
I know, but comparing those two versus Citi and Wells Fargo, they're juggernauts. When you do a size comparison on the assets, it's staunch.
Sure, but if we're comparing the big banks, we have to compare the big banks. You get me? I get it. Yeah.
I would argue that the top two are on a different, it's tiered, right? So Citi and Wells Fargo are together, JP Morgan.
Bank of America. No, I would argue Bank of America, JP Morgan are together. Okay. Morgan Stanley and Citi are together, and then Wells Fargo is just on its own. Sorry.
Well,
I know. Wells Fargo,
know. It is on its own, but I would argue Goldman Sachs and Morgan Stanley are together, and then Citi is kind of you could say Citi to Wells Fargo is the transition period. But regardless, if you're comparing, Citi being more apt comparison, right, to Wells Fargo, and they just consistently been doing their thing. So, to your point, yeah. But you can see that. I'm just saying, JP Morgan didn't have a problem with the dividend. Citi didn't have a problem with the dividend. They didn't increase it, but they didn't cut it either, right? Yeah. So I'm looking at this and I'm just I don't necessarily know how I feel about this. Actually, they've only had 1 year of increasing, which we just saw the graph. Ex-dividend date passed as of May 4th. Payout date was on June 1st, and they pay their dividends quarterly. So let me put this $1.20 over here. And this means that based off the current shares outstanding, they pay out $4.52 billion in dividends every single year. Now, let's jump into these fundamentals. We got the net income 5 years ago of $22.4 billion down to today of $14.4 billion. You thought Citi was bad? 35.76% down. Massive decline. By far the worst one that we have seen out of these three on 3 years ago. 19.72 billion down to 3.4 billion. Insane. Recovered, massive spike recovery 3 to 2 years ago, but then look at what happened from 2 to 1 year ago. Just meh.
Yeah, and look at this. What was going on 4 years ago? Why did they go down from 22.4 down to 19.7?
Interest rates.
5 years ago? 5 to 4 years ago? Okay, I guess they...
you're talking about... I was comparing 4 to 1. But before, Wells Fargo's had problems. This is pretty much known. I don't understand why Warren Buffett values them so much, but...
He does?
Again, certain people have certain opinions.
All right. So what would you give this as a grade?
A 50 or a 45.
Yeah. I was gonna say like 40 or 45. I agree with that statement. It's mainly because of, look at this. Even as of 1 year ago, well, first of all, we've seen in the other two that they've been coming back to the median. Even though 3 and 2 year ago were the outliers, the 1 year ago usually comes back to the median of the 5 and 4 year ago. In this case, it didn't, right? It's increasing as of today, but it's still way below that of the median of 5 and 4. So yeah, I would say 45%. Looking now into the revenue, we got 5 years ago of 84.7 billion down to 73.25 billion. Decrease on the revenue. That's not something you want to see. There's a decrease of 14%. Once again, the outlier here 3 years ago, but even excluding the outlier, just take into account 5, 4, 2, and 1 year ago. This is a pretty consistently decreasing graph.
Yep.
84.7, 84, 82.6, 72.2, and as of today, from 1 year ago to today, slight increase by around $1 billion or so, from 72.2 to 73.2. I'm looking at this, I'm just like, ugh, cringe. So what would you give this as a grade?
45. Same like before.
I would,
Yeah, it's a little better. 55.
Is it a little bit better?
You don't have as much staggerness on the 3 and 2. And then you kind of come back the 1, like you said.
Yeah, that's fair. So would you get 50?
55.
55. Okay, 55. Yeah, no, I agree with that. There's also less bounciness on this. It's not like, even the 3 year ago value didn't go down as much. Looking now into the shares outstanding. We got 5 years ago 4.58 billion down to 3.76 billion. That is a massive decrease of 17.86 from the previous year to the current year. Another massive decrease of almost 2%, 1.84 to be exact. And unfortunately, not consistently decreasing. They did have an increase slightly from 4 to 3 years ago, but you can say COVID related. So, yeah, right?
Yeah. And the thing is, like, they got a pattern of like decrease, pause, decrease, pause, decrease, pause.
I guess you could say that, yeah.
So it's
and
like
when
90,
they do decrease,
95.
Was it?
90, 95 for me. Just because you have a established behavioral history where you paused, cut, pause, cut. And even though you're doing it now, you're pausing, you could reinstate that next quarter or the next year, let's say.
Well, I don't think they're pausing though.
Yeah,
no. Repurchased $4 billion. They're not pausing.
Oh, okay.
Yeah. No, I think it's more of like they do a pretty good buyback, like for example from 2 years ago. Then they buy it back a little bit, not too much, but then they buy it back again by a massive amount. So that's kind of the way I see it. I agree with 90% though. And when it comes into the assets minus liabilities, this is one that's massive, right? This is one that's massive because you can see that even though it is in the positive, it's decreasing. We got 197.1 billion down to 183.2 billion. Average total assets, it is 1.9 trillion. Average liabilities is 1.7 trillion. This difference is 187.7 billion dollars. Again, it's decreasing. You can see here that they had a slight tick up from 3 to 2 years ago, but even then, look at this. 5, 4 decreasing, 4 to 3 decreasing. Ignore the 2 year ago value, 3 to 1 decreasing. And so far they're having a slight tick up, but then again, might be a blip just like 3 and 2 years ago.
Yep.
So what would you give this as a grade?
I don't like it, so because it's decreasing, about 50, just because it's consistently, but it's not terrible. So it's like you kind of weighing it, and again, banks.
55?
Yeah, let's go there.
55. All right. And with that, guys, we got the total grade: 45% for the net income, 55% for the revenue. Shares outstanding was the only good one here at 90%. And assets minus liabilities of 55, total grade of 61%. There's a reason why Wells Fargo is the bottom of the biggest banks. Even with us, 61%, guys, it's not looking good. It really, really isn't. I mean, it's almost there. Can they pick it up? Man, they really do have to clean up their business. Just aside from all the controversies, they have to do better, man. They really, especially in that net income category and even the revenue, right? Even the revenue. So 61% according to Mike. And yeah, it's not there yet, but maybe one day they'll be better off. I don't necessarily know. Let's figure out what they actually what we should actually pay for them. And book value as of today, based off of Seeking Alpha, we got $43.09. I don't remember what they were over here. Do you remember what they were over here? Did we even see it?
No, I don't think so.
I don't think they showed it. That's... Huh. I thought... Huh. Really? Yeah, look at that. They actually don't... Wow. Okay. No, not TNG. TANG. There you go. Tangible? Yeah, they... No, look at that. They actually... No. If I just put in here book value, look at this. Book, nothing comes up. Nothing comes up. That's very surprising. Very, very surprising. All right. Well, based off of Seeking Alpha, guys, they should be worth $43.09. And looking at the tangible book value, this is $36.40. If we take a look at this ratio for the price divided by this, we can see that based off of the current book value, it is 1.06, pretty much in line with the current price, right? And the tangible book value, it's a little bit more expensive, 1.26, but it's still not too bad, I guess you could say. But then again, guys, with their fundamentals at 61%, I don't necessarily know. And looking at this dividend, not that good of a dividend, but at least when it comes to like the consistency of it, they did cut it during COVID, so that right there should be a major red flag. Other banks didn't. Putting in $5,725, this stands to $150.17. So let's jump now into the technicals to see what they have to say.
Yep. So go into Wells Fargo. I covered this in the video yesterday. Basically, we got this trend line. We break this trend line, and then we probably head lower. It did have basically like a morning star pattern on here. MACD is getting ready to roll over. RSI is like trying to cross, but not really. I did say that we had a reversal signal yesterday, but again, it could reverse and reverse again on you. I know this sounds like Uno for some reason, but basically we look at this trend line to see where our next move is. Do we come to the bounce or do we not? And if we come to that bounce, then are we going to basically continue to bounce there and then trend up higher, or we're going to break it? And if we break it, I do see this gap here from previously that into this area consolidation. That's where I'd be looking, break the trend line, come back down to that $40.50 area, or maybe come back through this consolidation here and find a bottom around the $37 region. That would bring it closer to that book value that we were talking about, and therefore more in line with what the bank should be worth. And really a discounted rate would be the 36.30 area. Again, very close to that book value if we just jump over the weekly, just to make sure we didn't miss anything. As you can see here, drop down, pushed up. This could be setting up a nice massive A to B pattern on the way down. But again, with these larger patterns, it takes a very long time to play out, which completes down around $31.83, which is in the reversal zone. So anywhere sub 30 on Wells Fargo, probably be an excellent buy. Remember, COVID lows or 2020 lows, we're back at $20. So if we see true carnage in the market, I would say 26 is the largest I would go on the low end. But again, anything below 35, I would start accumulating, just because you'd be looking at this nice consolidation area that you could be coming back into and could rotate at any time. I don't expect that to happen until at least later this year. We need to see a couple more quarters, but we are starting to see the cracks forming in the banks. And I think that's been a general statement with all the banks recently. Now, if you get the upside potential, then I'll be looking at the resistance at $46.78. And then again, at this upper peak right here at $48.50 would be the two resistance points I'd be looking to either trim my position or get out. And with that concludes the technical piece of it, and just wrapping up thoughts, I guess, right? For Wells Fargo and let's say the other banks.
Yep.
They're all showing carnage. They're all showing pain. Just which ones are going to have more pain in the future? That's to see. And what does this mean for the, let's say, regional banks?
Well, I guess we'll have to see when it comes out to that one. Shout out, fellas. Thank you, self-prioritized individual, SPI. What's I gotta call you SPI? Yeah, I mean, when it comes to the banks in general, at least when it comes to a fundamental perspective, Citi is looking pretty decent. JP Morgan's looking amazing. It's just that it's overly expensive. Wells Fargo, it's it's pretty much in line with the price, but at the same time, it doesn't have good fundamentals. So that's kind of just our opinion overall. And yeah, I don't know. This is gonna be an interesting one, man. It's gonna be interesting, especially next week. Next week we have a lot of earnings, so let's see how this is gonna turn out. Again, really didn't impact the markets. These banks did not impact the market today at all. We'll see what happens next week. I believe Bank of America is reporting Tuesday or Wednesday, and a bunch of other small banks. Guys, we are going to pretty much live stream essentially every single day next week. So I know Mike loves to hear that.
No.
I know, man. I know it takes a lot. I know. But that's just earnings season. Is just that way. All right. And we are going to keep covering these earnings, especially when big tech comes out. That's going to be a massive one. So we're also going to cover some controversial topics as well as Bud Light. Really do want to cover that one as well because we've been seeing a lot of carnage with them. So that's going to be fun. So when they have earnings, we'll cover that as well. And yeah, guys, get ready because earnings season has begun and we're going to live stream. Even though if it kills us, it's not going to kill us. But even if it kills us, we'll still do it.
Just may main us and behead us a little bit.
You know, and then we'll take a break for about like a month and a half and then it'll be start all over again. But anyways, guys, that pretty much does it for this live stream. Thank you so much for watching. We really, really do appreciate it. We got a lot of viewership for today. We really did. At one point, I think we got like 12 or 13 viewers on YouTube.
13.
Yeah. And on Rumble, we got 9 people watching right now. So thank you all so much. Really, really do appreciate it. Guys, the best way that you guys can help us, if you do like this type of content, again, we would love to do this full time. We really would. That's our dream, right? That's our dream, to have a studio, to have like face cam, to just like have a TV and be like, all right, now let's pull that, now let's pull that, now let's pull. That'd be awesome. But is Bud Light bankrupt yet? I don't know, man. I don't know, but that's gonna be crazy. But that's our goal, and the best way that you guys can help us with that goal, you know, we're not gonna say no if you guys like to send us like super chats or super comments, but honestly, the best way it is just by liking, subscribing, commenting, and just sharing. That really is just help us grow the channel. We really, really do appreciate it. We really are trying hard, even though we're exhausted right now. We really are trying hard. So thank you all so much, guys. Really, really do appreciate it, and that will do it for this live stream. He needs to go to bed. I'm exhausted. I want to sleep. So peace out, and we'll see you all in the next live stream as well as in the next videos. Peace out.